it's not up to us to tell you what's good ESG or bad ESG. That's up to you. And that brings about a whole different emotional engagement to investors and how they behave through difficult market cycles. But our job is just to make sure that this is the index, this is what we're looking to track, and you tell us what goes in and what doesn't go in it.
Hi there, I'm Jamie Williamson with FS Sustainability, and welcome to today's episode of The Greener Way, where we're going to take a dive into a topic that's not typically discussed an awful lot in Australia, and that's direct indexing. Now, you're likely familiar with indexing insofar as passive investing in ETFs. However, you're probably less familiar with direct indexing, which, while having really taken off overseas, particularly in the US, is really in its infancy still here in Australia. It is growing though, and part of this growth is being driven by just how much easier or more effective direct indexing can make ESG or responsible investing. And to discuss this, I'm joined by Josh Persky, Chief Executive of Briefcase. Josh, welcome to The Greener Way.
Hey, Jamie, nice to chat with you.
So Josh, probably best to start with the basics. As I said, direct indexing is kind of still in its infancy here. What exactly is Briefcase and what is it that you do?
Yeah, good question. So look, essentially, Briefcase is an investment management firm, and we take the view that every investor is different. Our mission is recognizing that one size fits most financial products are no longer good enough. Being 2025, we feel very strongly that investors do deserve better, and our mission is really for all investors to access personalized, tax-aware, and probably more important for your listeners, values-aligned portfolios, and importantly, at low cost.
As I mentioned, it is definitely something that's currently probably more popular or prevalent in other parts of the globe. But can you explain what direct indexing is and how it actually works?
Yeah, 100%. I think the key is probably in the two words in the name, and I might kind of do indexing first. I'm sure many of your listeners are familiar with index-based investing. It's probably one of the most talked about pieces of the investment management world. I had a look at the data yesterday that as of the end of April 2025, there's over $15 trillion in exchange traded funds alone. In the Australian market, it's grown to 250 billion Aussie dollars. So that makes it about 1% of the global market. So I think investors are very comfortable with what index-based investing, and there's lots of reasons why investors have flocked to those. And the direct part of direct indexing is exactly that. If you think about the way that most people get access to an index-based strategy, it's typically through an ETF or a managed fund. Through those structures, investors actually don't own the stocks themselves. They own units in a trust that holds the stocks. So direct indexing in its simplest form is a strategy that basically looks to replicate an existing stock index like the ASX 200. But importantly, investors will have beneficial ownership of all the stocks in their index, be it in their name or in their super fund's name. So it essentially just breaks apart the wrapper, and because of technology, investors can actually own the underlying stocks in their own name.
Yeah, okay. How can financial advisors use direct indexing in helping their clients who maybe want to be more mindful about how they're investing their money?
Yeah, so there's probably two parts to that question. I think we see a lot of financial advisors that really want to, actually do believe in index-based investing, but want to be able to give their clients a stock-based portfolio. So the simplest way for them is to come to us and say, I want to track the Aussie equity benchmark, and we deliver a parcel of securities that will replicate and track that underlying benchmark. Where direct indexing really starts to come into its own is one of the big benefits is the concept of customization. And the way that I like to explain it to financial advisors and investors is, if you think back to the 80s and 90s, and I'm kind of harking back onto my own history, I'm a big music fan, and whenever I'd go to the CD store, I'd take out a CD, bit like the Red Hot Chili Peppers, and I'd put it down on the counter. I'd say, this CD's got 16 songs on it, but I only want 13 of them. And the person behind the counter would say, well, the CD's a package deal. You get what you get and you don't get upset. There's nothing you can do about that. But now in 2025, nobody uses CDs. I've got boxes of them up in my attic. We all use technology like Spotify to go, all right, I'm going to download all 16 songs from the Red Hot Chili Peppers CD, and I'm going to delete the ones that I don't like, and I'll change the order so I have my own Red Hot Chili Peppers CD-like experience. Suffice to say, financial advisor, when talking to their clients, would say, I believe in index-based investing, but my client has specific ESG views. And ESGs tends to be a bit of a catch-all in our industry, but it's very much an idiosyncratic need because it's values-based. There's no monolithic view of what's important to me should necessarily be important to you. So coming back to the CD example, financial advisors would have clients that say, I want to track the Aussie equity market, but I don't want fossil fuel stocks.
Mm-hmm.
Or I'm a cancer charity, I don't want tobacco stocks. Or I'm privy to material non-public information because I sit on the board of a listed company.
Yeah.
Or, it's a really, really, really long list. So if you think about ESG, and financial advisors can come to us and say, can you build me a custom portfolio that takes out all the ESG exposures I don't want, but still knowing that it's going to essentially track the benchmark really nicely?
I really like that CD and Spotify example because that's actually kind of one of the examples that I always use with new journalists that join the team here. It's, when they don't kind of understand what an investment platform is, it's sort of like, think of it as Spotify and you can put together the playlist that you want to, and the playlist is the investments that you want. So it's a good example, yeah. What percentage of Briefcase portfolios have an ESG tilt to them? And can you tell us kind of what they look like?
Yeah, I can give you some examples. So every direct index portfolio that we run right now is a fully customized portfolio. Our technology and our investment capability at its extreme, we can get literally 50,000 investors that want to track the same index but want to get there differently. So one might not want fossil fuels, one might not want exposure to cluster munitions, one might not want tobacco stocks, one might have specific views on specific stocks. So all 100 or 50,000 of them could essentially want the same risk and return of the benchmark, but want to get there differently. And our technology can do that. Some examples. So we've got some really, really, really interesting ones. So we've got a charitable foundation that has a really interesting view on the world. They're a cancer charity.
Mm-hmm.
And as you can imagine, their investment policy include some very strong wording about the types of securities they want in their portfolio, but also more specifically, the types of securities they don't want.
Yeah.
And they had an interesting example where they went out and they bought an ESG labeled ETF. And because the ETFs are fully disclosed, you can see the holdings every day. They noticed that it had some stocks in it that were essentially anathema to their investment policy guidelines. And that becomes a really difficult conversation to their donors, to their board. And they can't go to the ETF issuer and say, can you take these securities out? So they're kind of left with the only option, which is to basically sell out of that exposure. So they came to us and they said, look, these are the things that are important to us, and we can essentially just mirror that. So they didn't want tobacco wholesalers, distributors, retailers, manufacturers. And because of the data that we licensed through a very reputable third party on the ESG side, we remove those stocks from the investable universe, and we create a portfolio that tracks the benchmark, and it does that exceptionally well. So they're really happy on the risk and return front. So they're not being compromised, or the portfolio's not compromising on performance.
Yeah.
But it also enables them to go back to their donors and their board and saying, we can hand on heart say that this portfolio completely aligns with our philosophy. So that's one example. We've got another example of an institutional investor that ran a very successful business, very much focused on sustainability. And this was a family-owned business. And the family had some very strong views on ESG. It was interesting. I was fortunate enough to meet all members of the family. They're very engaged, as ESG investors typically are. And we went through this extensively long list of, well, what's important to you? How do you think about factors? And they thought about ESG along factor lines, the way that most institutional asset managers do. But they also had some really specific views on individual securities that might not get caught up or captured by a data series. So we essentially just gave them the list of every security in the benchmark, and they basically crossed them all out. And we got to the point where they took out about 40% of the market cap of the benchmark, which most investment managers would really struggle to build an index tracking portfolio off the back of. But we've managed to run that very successfully for them, and they're incredibly pleased with the performance, and they're telling all their friends. So those are just a couple of examples of where people could use it, but those use cases extend far beyond that. We get a lot of investors that come to us that say, I've got some existing holdings that sit in a separate account. I might have some really large unrealized capital gains baked into those positions. I don't want to sell them, but I don't want to buy any more. Can you take them out? So it's a really long list of why people do the things that they do. And our investment management capability and technology is really designed to accommodate a lot of that for financial advisors.
In terms of the logistics of direct indexing, the accuracy of data is obviously key when it comes to responsible investing, and it can be kind of difficult to get, really strong data points. There's a lot of things can be quite opaque when you're trying to look at these things. How do you ensure the accuracy of the ESG data used in your models?
It's an interesting question, and I think we kind of do it in a couple of different ways. I think typically the way that it's done is most asset management firms will rely on a reputable third party to provide their ESG data, and they'll have their own methodologies as to how they capture a score or specific metrics and apply it to a security. So we do that too. We have a licensing agreement with probably the most reputable ESG data provider in the institutional world. And that's where most investment management firms will typically stop. What we do is when investors come to us and they say, these are the exposures or these are the factors on the ESG side I don't want an exposure to, we run that through the data set and you get a list of securities off the back of it. So investors see, okay, well, I took out tobacco stocks and these are the stocks in the portfolio. If you come back to direct indexing, investors get full transparency on the stocks that they own because they're the stocks. Mm-hmm. So what tends to happen off the back of that is we get investors that go, yeah, I've run through the screens. These are the stocks in the portfolio. And they go, oh, this stock that's gone in, based on my view, for whatever reason, I don't want it in there. And it's not captured by the screen. And we say, that's totally fine. That's no different to an investor saying, I don't want this stock for any number of reasons. We just remove it from the investable universe. So we kind of put the power back in the investor's hands, particularly on the ESG side, to know that they get comfort that there's a really reputable ESG data provider that's doing this according to their methodology. So we account for that and we update that very frequently. But we also say, this is the net result. Does this still satisfy your requirements for ESG? And it typically does. But if it doesn't, because as you said, ESG changes, security classifications change, investor preferences change, investors can come and go, well, I can see the list of securities in my direct index portfolio. I don't want that one in there anymore. I don't want ABC holdings for whatever reason. So no problem. We'll just exclude that. And then we just rerun the optimization. So we kind of do it a couple of different ways. And there's a bit of education that we have to do there, but we're very much about giving investors the power to make decisions that are important to themselves. And our job is just to make sure that what's left over, we can track a benchmark appropriately.
What are some of the biggest challenges that you face, though, when it comes to kind of integrating ESG criteria into a direct indexing approach?
We don't tend to come across difficulties on the ESG side. So the biggest extreme example I'd give to that is if an investor comes to us and they say, I want to track the Aussie equity market, but I want to take out every single ESG factor that you guys have access to through a third-party data provider. And let's say it's a 200 stock universe, and based on their ESG constraints, they take out 195 stocks. Mm-hmm. It's very difficult for us to track a 200 stock benchmark with 5 stocks.
Yeah.
We have some fail safes in there to be able to say, look, based on our proprietary optimization capabilities, we can't hand on heart as a fiduciary deliver you a portfolio that will track the benchmark quite well. We'll show them all the research. We'll show them the back tests. We'll show them the asset allocation. We'll show them the risk. We'll show them how this portfolio looks materially different to the benchmark and how we expect it to behave. We can't hand on heart stand behind that. But if that's something you want to do because you feel very strongly about that, some investors might feel comfortable with that. So those tend to be the biggest challenges that we tend to face. The other piece that's a little bit interesting about us is that we're not an administrator. We're what we would call a model manager. Mm-hmm. So clients actually don't physically give us cash. So we go to family offices and financial advisors and we say, here's a direct index portfolio for your client. Tell us what you want it. So it could be any one of the wrap platforms that many of them are familiar with, or we also trade on a number of brokers as well. So building the technology integration to be able to do that seamlessly, but also to monitor the model portfolio or the direct index every single day to make sure that the portfolio is still a good representation of the benchmark. But also things like, rebalancing, corporate actions. We do all of that, and we fully automate that as a function of our investment management capabilities in team. So those tend to be the difficulties, but for the big ones that most advisors would think about, we've really thought about, because it's one thing to build a direct index portfolio and go, here's a list of stocks and here's a bunch of weights. It's another thing to have that cash managed. and monitored and rebalanced and reported on. And, because we've got, $50 billion worth of investment in management experience internally, we think about all of those things and we've addressed all of them.
Just finally, we've covered a lot, I know, but I just wanted to ask you about addressing potential conflicts between the financial performance of a stock or a company and the actual ESG goals.
Yeah, it's an interesting question. I wouldn't say that that's something we specifically think about. And what I mean by that is that our process is entirely quantitative. We don't take ESG views. And I think that's one of the really big differences between us and a typical ESG fund manager.
Mm-hmm.
Our job is not to tell people what's a good ESG stock or a bad one.
Yeah.
We put that back in the investor's hands. And I think that's the beauty of direct indexing. The mutual fund structure or the unitized structure of where everybody has to get pulled into everybody has to buy the CD, that doesn't exist in our world. So we don't get caught up in that. And that's important, and that's by design. And on the investment management side, once the investors told us what's important to them for ESG, for whatever reason, it's not up to us. We basically off the back of it say, yes, we can deliver you a portfolio with all of those considerations that'll track the index really nicely, or it won't. And, existing experience with our clients suggests that it's pretty hard for us not to be able to do it. There is the odd instance where it happens, but technology is essentially built to be able to say, it's not up to us to tell you what's good ESG or bad ESG. That's up to you. And that brings about a whole different emotional engagement to investors and how they behave through difficult market cycles. But our job is just to make sure that this is the index, this is what we're looking to track, and you tell us what goes in and what doesn't go in it. Throw the CD in the bin and just use the technology to build your own playlist.
Well, thank you so much, Josh, for joining us again. Thank you for being here on The Greener Way. I think I probably speak for a lot of us when I say that I now know a lot more about direct indexing than I did when we first started, and of course the way that it can really supercharge ESG investing. So thank you so much.
Thank you, Jamie. Good to chat.
And thank you for listening to today's discussion. We look forward to having you with us next time on The Greener Way.
The Greener Way podcast is a product of FS Sustainability. All information in this podcast is for education and entertainment purposes only. It is not intended as a substitute for professional, legal, or tax advice. Before making any financial decisions, you should read the product disclosure statement, and if necessary, consult a licensed financial professional. For more information, head to the disclaimer page on the FS Sustainability website, fssustainability.com.au.